Everybody, it's Dave. Friday, August 14th, sector update for the week. We'll try to do this usually on Fridays or Saturdays. Try and give you the bit of the rankings within the page. So, sort of above me on your screen here, what you can see is that I have a table. That's usually where I get all the data from, with all the different components that we look at. I tend to pull reams and reams of data, put it in a spreadsheet for you so you can see. So if you want to just kind of get a sense as to how all this works, I'm going to talk a little bit today about the healthcare, and I'm going to talk about the retail, because they're two very similar looking comp ranked stocks, ETFs. The indexes look kind of the same from a comp ranking perspective, but they're very different potentially from a trend ranking perspective. So the first comment I'm going to make is, as you can see it here, is this is the S&P Retail Index, and the S&P Retail Index has been basically in the top, sort of 1, 2, or 3 positions, probably, going back for the last 2 years. It's just, pardon me, not the S&P Retail, the S&P Healthcare sector. And it's been just a very strong upward moving sector, with very little chop within that, and that tends to give these sectors in any kind of security, the less something chops when it goes up, the more attractive it is relative to something that may have gone up the same amount, but it chops up and down. And especially sort of going back 2012, so the 2012 to 2000. Probably call it middle of 2014 run, there was just very little opportunity for investors to trade that, other than to sort of be long, and basically, ride it up. And we'll kind of go through that and show you what that looks like from the trend ranking perspective. So, in the case of the S&P Healthcare, it's got a composite rank of 8.9, which is pretty high. It's the high end of the bullish area. It's timing ranking, and you can kind of look at these a little bit more. And if anybody sort of wants to look at this stuff a little bit more detail, what you do is just freeze the video, and you can kind of see sort of how it is. I apologize, because right now we're doing it during live trading, and so that's why you're seeing some of this stuff. And you may even hear something, one of the algos go off in the background. But so in this particular case, it's got a 7 ranking on timing, so it's relatively attractive. It's kind of it's been selling off as of recent, and chopping up and down. And the second column here is actually the trend ranks, and you can see that it's got a far and away the highest trend rank. It's 9.57, so it's a 10. It's as far as the trend ranking goes on this, the probability is, even if there is short-term decline in the stock, it's really an opportunity to pick this up. You can think of this as institutions generally are not big sellers of this, and that they tend to want to buy whenever there's a dip. I mean, all good things come to an end, but in general, any kind of dip that's occurred in the stock, and the trend ranking for the most part has stayed within this area for the last 3 years, it's just been an opportunity to buy, and it's only sort of, even in the last let's call it 3-4 months, where we started to see a little bit more cycling activity, but there's just not a ton of cycling that even occurs. You're talking about a relatively small range with which this guy tends to go up and down between. So my outlook on this is that this is a great instrument to own, and I would still be an owner of it. I would still hold this particular position, and if there was weakness and there was some holes or cash in the portfolio, it's a very high probability buy that this thing is probably going to come back from any kind of dip. And I wouldn't look for a huge dip, because it just don't happen. But if it's down like a few percentage points from where it is right now, you can probably make that up relatively quickly over the next 1 to 3 months. So very strong trend rank, very strong composite rank. The S&P Healthcare is leader of all the sectors, and how I rank them. Now, I'm going to talk also about the second ranked sector, which is the S&P retail. The S&P retail is very interesting, and even though they have a very similar composite rank, the story between S&P retail and the story between the healthcare is actually really quite different. And the difference lies in the difference between the S&P retail's trend rank and the S&P healthcare's trend rank. The trend rank on the S&P retail is 5.5, and that is in the mid-range of trading. And it's interesting because the S&P retail tended to have a fairly strong run. It was led by a lot of strong internet retailers like Amazon. I'm trying to think who else is in there, but some very strong. Netflix is in there. So there's some stuff that's had some really strong runs that have kind of pushed out on the tech side. And then there's been a bit of a sell-off in that particular space. So what you've seen is in the case of the S&P retail that they've had a fairly sizable sell wave, but they, a couple of months ago were actually very, very strong. And so what that means is that if we take a look at the composite ranking, what the composite ranking is telling us is that the probability is actually really good from this particular point, especially since our short-term timing is at a 10. The probability is really good that if you buy today, you own the ETF today, that the likelihood that this will produce some absolute gains for you sometime in the next 1 to 3 months is very strong. But it's what you have to realize is that, and this is the big difference between the healthcare and the retail, is if you buy the healthcare here and there's a spike, the expectation is that you probably won't want to get rid of it. You're probably going to be early, and it'll be difficult to get back in. It's one of these things you have to worry about. In the case of the S&P retail, because you now have a trend rank that's putting the ETF in the trade range, very important to understand that what makes this an attractive purchase right now from a composite perspective is that the expectation is there's money to be made on the stock, but you have to realize it. So you have to take your money off the table so that if this thing does go to a bit of a pop and there is some money that's made in the particular stock, it's something that could quite easily cycle over and turn down. And this is generally what happens when a major breakdown is beginning to occur, is that highly rated trend ranked stocks tend to begin this process of breaking down, and once they break down, their trend rank begins to break down, but their composite ranking lags. And the reason is because usually everything that's fairly strong that begins to sell off, there's usually people that will step in to pick that up to buy it, and so it's usually an opportunity for investors to make a trade on that, or if you're looking to kind of lighten your position, what will happen is that the ranking over the next couple of months is likely to decline on the composite ranking. And how that'll work is that as prices begin to rise, the short-term timing component that makes up the rank is actually going to pull the composite rank down. And so quite literally, we probably are going to see, whenever there's a bit of an uptick in that particular area, that this is probably going to go from something in the 8s, which is a buy rank, to something that's going to at the top of the cycle, it's going to be sort of in the middle, what we call the trading range. I don't necessarily like the term hold, but it's a trading range where, as an investor, you really need to sort of take your money off the table, because the probability at that point is when you have a trend rank that's 553 and you have a ranking that's not necessarily that good, what tends to happen is that you're going to see potentially a significant amount of downside that comes. So the S&P retail is a trading buy right now, whereas it's still a long-term buy or longer-term buy on the S&P healthcare. And as always, everything evolves real time. There's nothing that we can say that this is going to guarantee over the next couple of years, especially since the expectation is that we're looking for weakness. So another comment, some few further comments on the the area. There's not a ton of securities that are in sort of this area where they're buy. The S&P Select Tech Spider, it's pretty close to a buy. It's in the trading area. It's the timing on that is I think what the timing is. So if we can look over here to the right, we can see S&P Tech Spider. So the timing is 6.2. So it's not necessarily great. If prices were to, what's going to happen is that if we get a rally in that sector, what's going to happen is that this is actually going to come down. The attractiveness is going to come down, and if there's a decline in price, this thing is going to start to make it work itself into a buy. But most of the other major sectors that are sort of commodity driven or whatever, with the energies and the oils, and we did a comment on oil this week, is they continue to be very poor. A lot of very poor trend rankings. We can see that from a pure trend ranking perspective, there is not a lot of stuff out there that looks particularly great. There's really only three areas, and this is the spider itself, that actually constitute what we would probably want to be in as buying and holding, and that's the financial spider at 7.9 and the healthcare. And then what we have is we have outright sells on quite a bit of things. And the industrials here, have a negative trend ranking. And it's only the timing component that's bringing up a little bit of the composite ranks. But even on the composite side, what we can see here where the cursor is that you have a lot of different instruments that are below 3 that are on the sell side, that are out and out, what we would consider to be shorts. And generally what happens is it's going to take a bit of time. Now there may come, some rotation that tends to occur with this, but as the design or the concept that we work with this and to talk about this type of stuff is really simple. It's that, this is something that you want to you don't want to be monitoring and watching all the time. So it's just a decision that, you would rather own something once it's reversed its negativity and showing signs of that. And most of those areas like the oils and the metals and that particular area are just not looking that attractive. So we'll see where this goes, but this is going to be something that occurs, and we're going to keep this format so you can actually freeze the video and you can actually take a look at the different trend ranks as they, what interests you, and then hopefully we'll pick a different area next week and discuss that.